Boy, time's flying. It feels like we just did one of these, doesn't it? I guess that was the March update. It's time for the April update. Hi everybody, I'm Brian Ullman, a financial advisor here at Ford Financial Group. And when we last posted one of these, we were finishing up the month of March, and things were looking good heading into April. The last 2 weeks of March saw a tremendous run in stocks, and we thought the bottom was in on March 14th, but it turns out the month of April had different ideas. We'll get into that in a second, but what I want to do is let you know right now first that in about 2 weeks, we're going to have our first in-person client seminar that we've had in a couple of years now. The title is Beyond Pandemic, where we're going to be talking about healthcare, life, and the economy post-COVID. So I would encourage you to email us at info@FordFG to RSVP your spot for that seminar. I'd also encourage you to sign up or subscribe to our podcast. We do these videos once a month, but we're able to crank out those podcast episodes about once a week. And so some more timely kind of real-time updates, you could say, for what's going on with markets and concerns about stocks, bonds, potential recessions, yield curves, so on and so forth. So I would say I will post the link down below and use it to subscribe to our podcast if you're interested in that. Also, if you haven't subscribed, I would say subscribe to this channel. Okay, that stuff is out of the way. Let's get into what's going on right now. As I mentioned, we had a huge rebound at the end of last month. We've gotten into April, and we're kind of back where we were at the depths of March. Specifically, the Nasdaq has dropped, as of this recording, 7% in 4 days. That is a tremendous drop, and we're back down where we were at the bottom of the market in mid-March. So we've retraced kind of back down to that correction territory. So why is this going on? I think we can really point to three primary things. And the first one may not be what you're thinking. The first one is actually China and what's going on in China with COVID and China's zero COVID policy, where they're locking down cities just on a few COVID cases. This is something that China has pursued for some time, but right now they're having I guess you could describe it as a small spike in cases, but the reaction is tremendous. And there's worry that what's going on in China can create some sort of global slowdown, global recession. I don't think we're so worried about recession here in the U.S. quite yet, but the worry is that we have this Chinese slowdown, and that can affect other economies in the world. And so that's number one. Number two is that we're seeing this conflict in Ukraine continue. And it's not so much that that's a real surprise there, although the inflation pressures coming from this conflict create some problems and add to the inflation pressures that we were already feeling before this broke out. The worry, though, is that there's some possibility this conflict could expand past just the borders of Ukraine, and that's problematic also. So not only has this war gone on and been pretty ugly and been more than I think what investors were fearing maybe as we began February, it seems as though the intensity is starting to crank up a little bit, and that's worrisome for investors. And then, of course, number three is what we have come to know and understand quite a bit, is that we have inflation here in the U.S. The Federal Reserve is committed to raising interest rates, and that can create a situation where it makes life a little bit hard. And so we're seeing that in the stock market and this dip. Where we are also seeing it is in the bond market. Now, you may know the S&P 500 is an index for stocks. It measures, is a kind of a broad measure of the 500 largest stocks in the U.S. When we say how is the stock market doing, usually we're talking about one of these indices, whether it's the S&P 500, Dow Jones Industrial Index, which isn't quite as good as S&P 500 as a measure, or even the Nasdaq, which is kind of one of the tech-heavy indices. The bonds have an index just the same. It's the aggregate bond index, the Bloomberg Barclays aggregate bond index. You can't say it quickly, but we'll just call it the bond index for the sake of brevity here. Just a few days ago, we were at a point where the bond index was down as much as the S&P 500. They were both down around 9% on the year. This is incredibly uncommon. Usually we diversify portfolios to make sure that things are moving, or try and have things moving in different directions. And so the kind of protection that you're afforded from bonds, if you have bonds in your portfolio, is some diversification and some offset, and we haven't been getting that this year. Why? Well, rising interest rates make life hard for bonds, at least in the short term. Now, higher interest rates are good for bondholders for the longer term. But that's hard to reconcile when we're looking at a portfolio and we're looking at our April statement, and here we are down again and not getting the protection that we were looking for from the bonds. Now, there are some things that can be done, but I would say now is not the time to panic and run the other way just because the bond funds and your bonds in your portfolio maybe haven't performed as you had hoped. We have a lot of volatility oftentimes in midterm election years, and some of that summertime volatility may have been pulled forward here as we start to kind of figure out what's going on. But it does truly feel like we're at a bit of a fork in the road in stocks. Unclear. We need some more information here as we get more earnings from companies reporting about how things are going and how the economy is doing and how really we're doing post-COVID. For the bonds, they've stabilized a little bit here as we finish out the month of April, which is a good sign. There's no way of knowing for sure, but it feels as though perhaps maybe the selling has been done, and so maybe there's some capitulation there and a good time for bonds to make the turn and move higher. We have a long way to go for this year, though, and we are not done yet. This is where good and bad decisions are made from an investment perspective. Making choices right now will affect how your portfolio performs over the next couple of years. Because we don't have signs of recession today means that for the intermediate term, let's call it, you could make the call to run to cash and abandon the portfolio, and you may live to regret it, or you could decide to stay put and understand that the kinds of volatility that we're having right now are normal. The abnormal part of things was the lack of volatility that we had last year. And even though these are new reasons for this volatility, we haven't had a sovereign country invade another sovereign country in like 100 years, and China continuing to deal with COVID. These are new reasons for volatility, but the kind of volatility that we're having and these market corrections are just about average. So keep that in mind as you're contemplating what is the right decision here for you and for your investments and what you should be doing going forward. Because I can assure you that in the throes of COVID in the spring of 2020, or in the throes of the Great Recession in 2008, or even the tech bubble burst in the early 2000s, I think there are many people who sold, got out of their portfolios, and lived to regret it after the fact. So keep that in mind, that over time, we've proven that markets can be resilient and ultimately bounce back. I'm going to leave it there. If you're interested, again, I'll remind you, RSVP at info@forwardfg.com for our Beyond Pandemic client event on May 10th, on Tuesday, May 10th. Also, subscribe to our podcast so you can get these updates a little bit more frequently. The link's below. And subscribe to these videos if you'd like to see more of them in the future. My name is Brian Ullman. I look forward to talking to you in May.